All righty. Well, ladies and gentlemen, Happy New Year. Welcome to 2021. First and foremost, congratulations for surviving 2020. And, Jim and Jaimee and Janet and I were, we were in the office and, if there was one thing to be said with everything that went on last year, we wanted to just say, congratulations in a real sincere way. Last year was just a crazy year with the markets and with the economy, and of course with the election and stuff like that. We've had a lot of phone calls, a lot of conversations, a lot of emails, a lot of back and forth, and you listen to our advice. We stay calmed. We press on forward, and now 2020 is behind us, and we're here looking forward to 2021. So we just wanted to just say thank you. And, you guys are amazing. Again, just with real sincerity, we are very appreciative of you guys and, just good job for sticking it through. So if you don't know who I am, my name is Daniel Carnes. I am one of the associate advisors here at ElderAdo. I'm also the investment analyst here. So this, we like to do typically a seminar about January, February, and then also another one sometime in September. So we're kind of keeping on track with that kind of model. But then, of course, we really miss hanging out with all of you in a nice big hotel, or not hotel room, I'm sorry, hotel conference room, and doing all that stuff. So hopefully, one day we'll get back to that. But for right now, just with everything going on, we just wanted to start adopting the new technology, start using Zoom. So we'll jump right on in for today. Let me go ahead and get my slide going. Okay, so this real quick, just a disclosure slide. This for educational purposes only. Please conduct your own due diligence and research. Consult with the registered investment advisor. Please don't sue me. That's the joke. And so what are we going to be doing today? So I'll be kind of doing a 2020 market recap, and then Jim will actually be going into 2021, just kind of what our outlook is. And then my way better half, Jaimee's going to be finishing up with some tax changes and financial planning tips. So let's go ahead and jump right in. All right. Well, again, like I said, you guys were amazing. You stuck through it, between COVID, the social unrest, the craziness, like the fires over in Australia, and then of course the 2020 election. It was a really difficult year, to say the least. And it was just, we got to see something very interesting. And I'll kind of go more into that, later in, my segment of this talk. So kind of what we saw in the third quarter, if you remember the last webinar we did, I talked about how, from 2019 going into 2020, we were doing really well. What was it? The gross domestic product, that's a standard measurement of economic growth. We were doing great. And then, February of last year, we started having some problems with COVID and then the lockdowns. And then in Q1 of 2020, it went down 5%. And then it really took a big hit in Q2, being down 31%. And then since then, it's just been booming, like 33% in Q3. We still have to wait and see what Q4 numbers look like. But so far, it's been pretty optimistic. Another good reason for a little bit of optimism is, kind of the same thing with unemployment rate. We had a 3.5% unemployment. That was the lowest we had ever seen in like some 50 some odd years. And then it just went a really sharp spike when lockdowns happened. And then it's gradually worked its way down all the way just a little bit below 7%. We're currently still at that 6.7% unemployment level. It's kind of been a little bit of stagnation and really kind of moving on forward. I don't think it really is going to change all that much unless everything just drastically opens up. You got, states like California and New York have some pretty strict lockdowns. So currently, just as it is, we kind of see a little bit of, we could see some stagnation. Of course, we want to see what Q4 of 2020 numbers look like. And then, of course, this is just a picture of the broad market. You can see at the beginning of 2020, we had, we were doing pretty good. We were on an uptrend, and then the lockdowns happened. The S&P dropped like some 35% in 24 trading days. That is insane. One thing that happened, the other thing that happened was that we had a massive rebound, and it was something we weren't really expecting, to be quite honest. We knew that the Federal Reserve, our central bank, they were basically printing money and just blasted the financial system with a lot of liquidity. You know, in the industry, we call them bazookas. But so there was a lot of this liquidity being pumped into the system, helped create a backdrop to kind of help the market from bleeding out. And then, you know, what ended up happening was the retail investor came in and started propping up the markets. Well, then it just kept going up and up and up. I kind of don't have any like data to back this up, but my main hypothesis, with everything being said, when everyone was furloughed and laid off and, you know, couldn't go anywhere, you know, people still had food to put on the table. They still had to put, you know, they had to feed mouths and they had to pay the rent and, you know, do whatever it is they need to do to survive. And so my hypothesis, and again, I don't have the data to back this up, but my main thought is, they basically went to the stock market and figured out, well, if, you know, let's see if I can make money off this, you know, the stock market, and see if I can help supplement that lost income. And then, you know, from late March going up and beyond, you know, going into September, we saw increased volatility. We had a nice dip there. And a lot of that was a mix of September being the worst performing month historically out of the year. And then, of course, right before the 2020 election. So, we had all that going on. And so far, so good, you know, with the markets are, you know, going up on an uptrend right now. You know, we still have a little bit of, not to be pessimistic, but we still have a little bit of skepticism. You know, we have the economy down here, the markets are up here. They're interconnected. One precedes the other, but they're kind of a little bit discombobulated. So we're kind of having a little bit of skepticism there, but we'll just have to wait and see what happens. So one question we got a lot from our last webinar was, Daniel, should I, you know, when I look at my accounts, you know, what should I peg that account's performance to? Should I look at the S&P 500? Should I look at the Dow? And the real honest answer to that question is neither. This picture that you're seeing right here, this is what's called a heat map. And this is the S&P 500 performance for 2020. And if you look at this long enough, you'll notice, you know, one of the things you should notice is, you know, the size of those boxes. You know, you got, and the bigger boxes in this picture, you got Apple on the far left, and then just above that is Microsoft. Over to the right, more of the center of the box, you have towards the very top, you have Google and Facebook. And then right next to them is Amazon. And then actually in 2020, in December, Tesla was just added. So that's, you know, one of the big boys, you know, could be considered one of the big boys in there. Well, you'll notice is that those particular stocks, the boxes for those stocks are really big compared to like a lot of other companies like Verizon or JP Morgan or Disney or ExxonMobil and all that. So the one thing to understand about stock indexes, they can be a little bit misleading. So the S&P 500, yeah, it's 500 stocks or 500 of the largest companies in the United States, but 20% of that index, this S&P, which is cap weighted, 20% of that is dictated by 5 tech stocks. So if Apple, Microsoft, Google, Facebook, and Amazon, you know, let's say they all have a bad day, what do you think the S&P 500 is going to do? There's a good chance that it's going to be going down to, you know, those 5 stocks are going to weigh down the index. And so, you know, one thing you have to keep in mind is that when you look at the S&P 500, we primarily use it as like a temperature gauge to see what the markets are doing and what they're feeling that day. But the indexes don't keep in mind your financial goals. So this next slide I wanted to show you is the dividend yield for the S&P 500. And it's the same thing. You know, you got all the different stocks. You still got Apple, Microsoft, Google, Facebook, all that jazz. But now you notice that those 5 tech stocks, they're not as green as the other ones. Well, Google and Facebook and Amazon, they really don't pay a dividend. But if you look at like oil and gas, or you look at drug manufacturers or banks, you'll notice that those boxes are more green. Well, they're typically, those companies pay a dividend. And so the point I'm trying to make is that what you can do is look at yourself and what your financial goals are. And then you can kind of gauge, well, you know, should I be focused more on growth? Should I be focused, you know, should I be exposed to more growth mindseted companies like Google or Amazon? Or should I, focus more on income? Should I focus on high yield dividend stocks like ExxonMobil, or utilities, oil and gas, the banks, the drug manufacturers, and so on and so forth? And so, these are the kinds of questions that we really have to ask and get to the bottom to before we just say, well, this is my account and this is the S&P. Why do they not match up? The indexes do not keep in mind your overall financial goals. So someone that's younger, they tend to be very more growth oriented. They want their money to keep up with inflation. They want to grow it. As someone gets a little bit older, they retire and they want to supplement that income. They're going to focus more on yield and income. And that's where like oil and gas and utilities and all those dividend paying stocks come into play. And then just to kind of help drive this whole point further, if you look to the left, in 1980, these are the 10 most valuable companies in the United States. You got IBM, that's a tech company. AT&T, that was before they had to break off into all the different bells from the antitrust lawsuit. So that was the telephone company. And then look at everything else: Exxon, Standard Oil, Shell, Mobil, Standard Oil of California, Atlantic Richfield, and GE. Oh, and number 5, I just have to say, at first I thought it was Schlumberger, but apparently they don't sell hamburgers. It's actually Schlumberger. Thank you. So that's an oil company. So if you look at that side of the list, it's all oil companies. Well, then look at today. On the right, you have Apple, Microsoft, Amazon, Google, or Alphabet as their parent company is, Facebook, Berkshire, that's Warren Buffett's company. You got Tesla, you got Visa. So a majority of it, or a good chunk of it, is going to be those big giant tech companies. So you kind of have to look at what's the overall trends in industry and technology, and who's the big dog, and what's happening, and how is our job force transitioning it from industrial to more information age like we are now. So there's all these different things that changes, and so we have to figure out which is more appropriate for you and your financial goals. One other big thing that, and I briefly mentioned this in our last webinar, is prior to 2020, we had typically advisors will have a select list of about 500 different mutual funds and exchange traded funds to choose from. We can construct models from that, whether you're conservative or more aggressive or somewhere in the middle. And this pick list is really important because we're able to trade in your account without charging your accountant a commission. So prior to 2020, we only had a select list. Well, then the broker dealers like Schwab and TD Ameritrade and Fidelity, they decided as an industry to say, okay, we're going to go ahead and make exchange traded funds, commission free. And so this was a really big opportunity for us. It's like, oh my gosh, there are all these funds that we didn't used to have access to. Funds like from Vanguard, or iShares through BlackRock. We had Spiders and Eaton Vance and T. Rowe Price. Wisdom Tree is another big one. So all these funds that we didn't have access to, or at least didn't have access to without charging your account a commission, it was open season. So this was a really big deal for us. We were like, okay, we got this whole, instead of 500 funds, now we have some 3,000 funds to choose from, and we can start doing some analysis and figuring out what we want to add and take away from our pick list. Well, it was the perfect storm, because right when that happened, and we were kind of in the process of updating our pick list and our investment pick list, COVID happened. The market's tanked. We were kind of in the middle of the storm, and when you're driving and you're in the middle of the storm, you can't see half past the windshield. You really don't want to move because you can't see what's going on or where you're going. So once we got past COVID, and once we kind of started working our way into the rest of 2020, that's when we had a very unique opportunity. And the silver lining with what happened with our pick list was, okay, we have 3,000 new ETFs that we can trade with. We can now look back and see how these funds performed in an actual financial crisis like 2008, and actually look at them at what happened in a self-fulfilling prophecy that was COVID. I mean, if you have a whole working economy and everything's hunky-dory, and then you shut it all down, you're going to have double-digit unemployment. You're going to have negative GDP. So we were effectively able to look at, okay, what on our current pick list did well? What did we want to keep? And then also what was something new we wanted to incorporate or keep in, and from that whole experience, and this is kind of where the silver linings coming into play. From that, we were able to effectively, update our pick list, figure out what we felt were the best funds to invest our clients' money in, and then build the models from there. And then moving forward. So one of the things I will say for 2021, and I'm really confident as far as the investing side of things and the different funds we're in, we feel that we are in a way better position than we were a year ago on the investing side. So now that we're after COVID, now we're going into 2021. We have been we've been really busy trying to get everyone flipped over to the new models and to the new investments. So Lord forbid, if we go through COVID round 2, we feel that we're in a way better position to handle that volatility. So I will leave it at there. I'm going to have Jim come up, and he's going to give out the 2021 outlook.
Okay, thank you, Daniel, for that. And so we're going to start talking about what we will do. Daniel talked about what we did and how we got you through 2020. And again, I want to thank you for all the clients holding on, listening to our advice. Those that did relatively well. So I'm pleased with how things turned out the best we can. So looking at the slide right here, it says we're going to look at 2021 and what we're doing, what our plans are for that. Down below it has 2020 with the 5 stars. Most of us, if it's a review rating for the year, I think we'd get only a half-star rating for 2020. But we're going to move on here, and we're going to look at comparing the global crisis of 2008 to last year. If you look at the top left corner here, you can see how the markets fell from November of 2017 all the way down to about March 9th of 2019. It fell down, but then it climbed up over the years, and it has recovered very nicely. But what happened last year is we had January and part of February was doing relatively well. And then we just had a cliff of about 3 weeks of precipitous drop. And then the markets then gradually climbed on up through that. Those people that panicked at the bottom of the market have lost substantial amounts of money. We held on, we stayed steady. We made adjustments in portfolios to be able to protect the assets. And then looking down at the lower left corner here, you can see the blue line, and that's the Fed funds rate. So during the whole 2008 crisis, the fund rates kept dropping and dropping and dropping and dropping until they couldn't go any lower, and it stayed flat for many, many years. What happened last year, the Fed rates, they had 2 rate cuts, and it was basically a cliff. They had one significant rate drop and then another one that fell down, and it's flat. They're looking at keeping the Fed funds rate low for at least the next 2 years. So we'll talk about that with the bond holdings and so on, and how that'll affect your portfolio. So this mirrors 2008, but in a very short time period. It follows a pattern similar to 2008, but it will only happen in months instead of years. Looking at this slide, looking at the global economic outlook, analysts are predicting that the United States, on the right here with the map, will be growing about 5% this year. They're expecting Europe to be about 5%, emerging markets in the undeveloped areas like South America and Africa to be about 6%, and they're expecting China to be about 9%. So China is expected to be the best place for growth going on. Looking on this chart on the left, what happened, the United States fell about 3% in their GDP, but they're expected to do 5%. The one that got hit the hardest was Europe. That was in Germany. And remember the stories about Italy with all the COVID cases in Europe and England and so on. Europe got hit really hard with the COVID and then affected their economy as well. So they dropped substantially in 2020. This year, it's supposed to grow about where the United States is expected, which is 5%. And then looking at China, actually, China had a positive GDP. They got hit hard early. We were all kind of watching China and seeing how they're going through it, and we weren't affected. And then it came over to the United States, and we got hit. But China survived last year, and they're expected to do very, very well in this year. Same with the whole world. The world got hit somewhat, not as bad as the United States, but it's expected to have a strong return as well. So we're watching for those places. We're going to be avoiding more of European type of countries and investing in there, and looking at China and the United States. Now, looking at the interest rate projections, again, you can see the yellow is the Fed funds target. Since the recession of 2008, back in 2016, they were creeping up the rates, climbing and climbing. And some of those folks of you that invest and have money in bank CDs, we're seeing that CD rates were climbing gradually, and you could get a decent rate of return. And then what happened was the economy got soft in 2019 a little bit. They cut the rates minimally, and then we had the COVID come along, and then they dropped the rates way back down, actually down to 0.25% interest rate, which is even lower than the 2008 market crisis. And so, and we're also looking at U.S. Treasuries, 10 years, and those were climbing as well with the yields, but then those have dropped as well. So we're seeing low interest rate to keep the economy moving along. So how to trade markets after this election that we just had. We talked last time about what are the possibilities of a Democrat president and a split Congress and what would happen here and there. We're in the green box here. We have now a Democrat president and a Democrat Congress. People are saying, well, they're calling the blue wave, and I tend to think it's more of a light blue wave or a baby blue wave. It's not very bright blue, because you have to look at it. We have a Senate that has a 1 vote advantage in the Democrat Party. And then the House of Representatives, the Democrats have only a 5 vote advantage over the Republicans. So it's not a strong majority, but it's just very narrow. So what that means is there's going to be a lot of compromise. If they want a bill, you're going to have to convince all 220 some U.S. representatives to follow that. And so it can't be so one-sided, because you have a lot of moderate Democrats as well as moderate Republicans also. So the bills won't be as strong as people are worried about and concerned about. And so places where we'll be looking at investing will be in the U.S. dollar, transportation, in energy, clean energy, alternative energy, and we'll be looking at other places to invest in, which would be durables, consumer goods, and so on. So we have some various places. What investments worked well under the Trump administration most likely may not do as well under the Biden administration, and vice versa. So our portfolios will be changing some. You'll be seeing some adjustments as we continue on. Okay, so how have the markets performed over the various presidential elections? And we've had, I won't go through them all detail, but Republican sweep has averaged a 13% rate of return. A Democrat president and a split Congress performed the best at 14%. This area here is a Democrat sweep, and they have averaged 9% a year over the history over the last several decades. So 9% is what the markets have performed. It's not the best. It's not 14 and 13% rate of return, but it's not down to 5 or 6. So analysts are expecting a reasonable rate of return on the investments, but they're not expecting stellar up or total market crash. So that's just the history of what the markets have done. Oh, since 1933, I see here. And then let's look at the market outlook. So let's look at the fixed income, the bond market right now. And let's look at the US credit focus is that we'll be looking at more intermediate bonds and higher quality bonds into portfolios. We've have a lot of short-term bonds right now because when they lowered the rates, that affected that, and we needed to stay in the short-term market. And then looking at opportunities in the emerging market debt, that means that these are small companies that are startups. Last year, when we were all sequestered at home, there were a lot of people that were stuck at home and they had time on their hand and they came up with ideas to start up companies. So there's a lot of startup companies in the emerging markets. So we're looking at that. And then also on treasuries, we'll still stay on the shorter term maturities for right now. And then looking at the global equities, we'll be looking at the short-term uncertainty. Right now, there's the vaccines that are coming out, and we just don't know how many vaccines they'll be able to distribute and how companies will deal with that. Will people start flying more? Will people start traveling more? My wife and I went to Bismarck, North Dakota to see our daughter, and the airplanes were pretty full. Airport was pretty busy, and it was just travel was getting closer to normal. That was near the Christmas time, so it was not like a Christmas rush, but it was a very busy time. Danny and I flew out to Denver back in September, and it was an empty airport and empty all kinds of things that had to do with travel. Car rentals and hotels were very empty. Nobody was in them. We were in this large hotel in Denver, and there were about 5 rooms that were being rented out at the time. And now the hotels are starting to fill up. So the short-term uncertainty will stay around until we can see some clarity and some improvement with what's going on here. The other thing is that our clients are older, and I've always like to have dividend paying stocks in our portfolios. Last year and previous years, dividends have not paid quite as well, so we've had to go into more growth companies. But now we expect a turning in the markets that values and dividend paying stocks will do better, so that will help those folks that are living on a fixed income and having investments and they're into retirement. That really helps you folks that are in retirement. An emerging market focus, again, we talked about emerging markets, companies that are starting up, that are young. They may not have the stability and the size, but there's a lot of opportunities there. A lot of things have been invented and that are being implemented nowadays. And then we want to also reduce the international developed equities. That means basically Europe. Europe is a developed continent where they're experienced and they've been around for centuries and centuries. So it's a developed area, and Europe again got hit hard, and they're expecting them to still struggle next year. So we'll be avoiding more of those areas. And then looking at the macroeconomic, we're going to be looking at the U.S. monetary policy. They're going to be very accommodative, meaning that they're going to be needing, if they need to print money, they'll be printing money. They'll be keeping the interest rates low, whatever it takes to keep this economy moving. It's very fragile right now, but it has a lot of potential for good growth. We're still expecting low treasury yields. And again, low treasury yields also indicates low CD rates and so on. So a lot of folks will be moving money from banks over into other investments. And that's what we've done a lot of recently. And then the unknowns of the COVID evolution. How will the vaccines work? How many can they get out? I know there's a long waiting list here in Montrose of people wanting to get a vaccine, and it depends on how fast they can get them out and get them distributed and so on. And then fiscal stimulus, that's coming from Washington, D.C. And so what is Congress going to be doing to help stimulate the economy in certain areas? They were doing broad brush policies, and now it's getting more focused. They might focus a bill just on the airline industry. They might focus a bill just on the leisure industry or hotel and lodging industry. There might be various things to help certain areas. So fiscal stimulus will still also be important. Looking at investment outlook for 2021, a few areas. I won't bore you to death with all of these numbers, but the U.S. Equities, they're expecting anywhere from a 3.7% to 5.7% return. That's just stocks in general in the United States. The value stocks are expected to do best. Were 4.8 to 6.8. The value, which are the dividend, the big, large companies that produce a profit that pay out a dividend. And then growth not as strong as it has been in the past, and so on and so on. So we're expecting some good returns in some areas that not quite as much. And that's whether it's equities or fixed income. Okay, so I'm going to just give you a summary here. A lot of people have been calling us and we've been talking, and folks have been saying, what about this going on in Washington? What about this in Washington? And they're watching the news and they're panicked. And so I'm going to share with you, Wall Street doesn't really care about what goes on in Washington. They take a look and glance at Washington, D.C., but they really care about Main Street. All in the long run, all companies really care about, and the stock market really care about, are earnings. Are these companies producing a profit? Are they making product? Are they employing people? And are they producing and earning? And so that's generally what they care about. And so all the sideshows going on with the news and the media and everything else, Wall Street generally doesn't really care about that. They want to say, are you producing something, a product or service, and what are your profits? And if you're doing well, which many companies did very well last year, then that's why the markets are up so much. So many people still equate elections and happenings in Washington with their personal money. And yes, there's some correlation, but very minimal compared to what people think. So turn off the news. Disconnect from the, I call political social media. Yeah, if you want to get on Pinterest or something fun, but don't get into these arguments and all this other stuff that gets into the political area, because these are sideshows. I also say keep a long-term perspective. People not happy with the election, remember, House of Representatives are only in for 2 years. Presidents are only in for 4 years. That's a pretty quick time if you look at investing. Just keep a long-term perspective. It doesn't matter who's in office. Under Ronald Reagan, we made money. Under Bill Clinton, we made money. Under George Bush, we made money. Under Obama, we made money. We made money under Trump, and we'll make money under Biden as well. So don't panic. Don't worry about what's going on these sideshows. Don't make hasty decisions. Unfortunately, we had 2 clients last year in March at the bottom of the market, panic, say, get me out. One lady was crying and she just says, I just can't handle it. I said, this is going to be a major mistake. And she lost about $250,000 because she just could not stay in following our recommendations. Well, if she stayed in, she would have gotten her money back plus a nice return. But no, she lost a lot of money and she made a hasty decision, got her emotions involved. We're the professionals. You've hired us. If you're a client, you've hired us and helping. So our job is to help you through these difficult times. Okay. And then the final part is enjoy your family, friends, and hobbies, and don't get wound up in all this stuff. But I really encourage you, if you have concerns, please call us. Let's sit down. Let's talk. Let's calm you down, give you a perspective of what's going on. I'm not saying everything is rosy, but I'm not saying we're coming into an abyss either. So we have something in between. Your portfolio will be will be okay over the years, and we'll just look back at it as another time period. So again, just look at what's important in your life and spend your time with your family. So I'm going to pass this over to Jaimee, and she's going to finish up with about tax changes and financial planning. So thank you very much.
All right, so thank you so much, Jim, for going over what we have to look forward to this next year in 2021. And so what I would really love to dive into today is about taxes and how can we reduce your tax liability? What tax changes do we have that are coming up now that we're in 2021? And just a few little tips about financial planning that I'll get into here at the very end. The first thing I think that's important to mention is RMDs. So those fund required minimum distributions that you need to take. In 2020, the CARES Act said, hey, we're going to take a holiday on RMDs and not require them. Granted, that came out in, I think, March. So some of you already may have taken it. But for those of you that are RMD age or have a beneficiary IRA, just a reminder that in 2021, it's time to start taking those again. So for our clients, I think Janet is probably already touched base with you. If not, we'll be doing so to make sure that we kind of get those moving for you. Also, all sorts of changes with RMDs. As of the beginning of last year, they changed the age that you have to start taking out of your IRAs. And so that age is now 72. And at the bottom, this little graph that I have right here, this is what shows kind of where you fall on if you need to start taking it out at 70 and a half or 72. But at this point in time now, it's, when you're 72, as long as you weren't taking it before. And then the other thing in terms of RMDs that changed at the beginning of last year is they changed the way that your the rules that go along with inherited IRAs or beneficiary IRAs. So when you inherit that money that was in a retirement account, the new rule is actually that you need to take the funds out within 10 years of receiving it. But it's a little bit funky if that happened last year, because last year RMDs weren't required, so you might even hit 11 years. But let us know what questions you have, because RMDs can be very specific to your circumstances. So we're happy to help you out with how you want to do that. But just like I said, reminder that RMDs are a requirement again now in 2021. So kind of moving on. So when you take an RMD, obviously that counts as income and taxable income that you have to pay taxes on. So looking at ways you can minimize your tax liability, one option for those of you that are taking those RMDs is to do a qualified charitable distribution, aka QCD. We love acronyms in this industry, so figured I'd throw the acronym in there for you. So if you're required to take that RMD, what you can do, instead of just taking the money out and putting it in your bank account or putting it in your individual account and paying whatever your tax rate is on that distribution, what you can do is take that money from your IRA and send it directly to a qualified charity. So the benefit of doing that, obviously, you get to help out whatever charity is near and dear to your heart. But the other positive of that is you therefore will not need to pay your income taxes based on that distribution. So it's a good way of getting your RMD completed, but also helping a charity and minimizing your taxes. In order to do a QCD, you need to be RMD age, obviously. And then the other thing is, in order to get those done, it requires a little, pretty simple, but little paperwork. So let us know if you're interested in this, if you're thinking about it and just want to talk through it, or if you're kind of sold and want to get the process going, we can help you out. But QCDs are a great way to help other charities, help people, and minimize taxes. Another tip that you can use for minimizing taxes, now this is a little bit for those that are not of RMD age, so we're kind of moving a little younger. An option is contributing to an IRA or other retirement account. There's two ways you could save on taxes now or taxes in the future. So the way to save on taxes now, if you're eligible, is to contribute to an IRA or retirement account now. And so basically by doing that, you can deduct some income on your taxes and essentially pay less taxes when you file, or kind of reduce your tax liability when you file now. And then that money gets to grow without taxes all the way until you pull it out at your required minimum age, or sometime when you retire. So that's a great way of saving money now. You get that tax deduction. Another option, if you're looking for tax savings kind of for your future self, is a Roth IRA, where you pay taxes on the money, you get your money in your paycheck in your bank account, then you contribute to said Roth IRA, and then that money gets to grow tax-free until you pull it out, and even then it's tax-free. So Roth IRA is a great tool for that. So as the tax law stands, that's how those work. So looking at saving into retirement plans, the government does want us to be able to save, so that's why these exist. So they're really great options for kind of saving yourself in taxes, whether it be now with deductions or letting your account grow without having any taxes on the growth. Really great tools. So let us know if you're interested in getting started on one of those, or want to know a little bit more about, are you eligible to contribute to those and what amounts. Another tool that we have to help out that we do actually very frequently, did a whole lot last year, is called tax loss harvesting. So this is when you have a taxable account or non-retirement account, whatever you want to call it, and an account that basically you pay taxes if you sell stuff, pay on dividends, gains. What we can do is tax loss harvesting. So right here on this slide, you can see two options, and I'll talk about this first one first. So this is your basic. You have, fund A, we'll say it's just Apple for simplicity. You have Apple, say Apple gains 30,000 and you sell it, and then you end up paying a 15% tax on those gains. So therefore you're gonna owe a good chunk of change. What we can do, and what we did do a lot last year, is tax loss harvesting. So you still have this Apple and you sell it and have that 30,000 gain. Nothing changed there. But what we do is, often when the markets are down or you have a holding that's at a loss, we'll take advantage of said loss and sell out. So here we sell and you have a loss of 15,000. But then what happens is these two cancel each other out. So 30,000 minus 15, you have your net gain of 15,000. So notice how you have less gains. And so when you have that less gains, then there's less tax owed. So that's a thing that we do a lot when we see the markets dip down for a little bit, or even extended period in March. It's a great time to take advantage of any losses and cancel out those gains. So say you have a holding that you've had for years and years and years. Sometimes we can sell out of that and prevent you from having to pay a lot of taxes through tax loss harvesting. We do it a lot. If you have questions, we're happy to talk through it, but very common thing that we do a lot for our clients. Another way you can reduce your tax liability is through charitable giving, but not through your IRA, as I was talking about before with the QCD. This time, this charitable giving is through assets in your taxable account. So I have an example right here. So assume you have $450,000, and if you were going to say, okay, I'm going to give this to this charity that I love, and you say, okay, I'm going to sell out of my holding. So we'll just say Apple to keep it simple. But say you have this much in Apple, you sell out, and then you have to pay obviously taxes in those long-term gains. So then effectively, if you do it through this cash way of selling out, then you only are going to have about $414,000 to give to the charity. But a way you could kind of prevent this 35,000-ish in taxes and give more to the charity is by giving those monies directly to the charity. So this example right here is if you were going to give it to Fidelity Charitable, but there's so many organizations you could send it to. or a donor advised fund. There's a lot of options here that we can talk through. But this one, you basically take these securities or this $450,000 worth of Apple, and what you do is you transfer it to the charity that you would like to receive it. Notice there's no tax that you pay when you do that, and they get the full amount of the securities that you wanted to gift. So it's a really great idea to kind of just gift specific stocks or holdings to charities. A lot of times the charities will have their own account open up somewhere ready to receive this. And then when they receive it, they can cash it and use it for whatever they need the most. So a really great way of, like I said, minimizing your taxes and helping out whatever charities are close to your heart. So another just kind of thing to keep in mind, I don't know if it's necessarily a strategy you want to employ, but it's something to keep in mind as time goes on. And this can happen if you're, maybe getting up in age and say you don't need to use some of your assets in a taxable account. Say you're able to, live off whatever your IRA has, and you want to leave the rest of your funds to your heirs. What you can do to minimize taxes on both sides is when you pass away, there's something called a step up in cost basis. This graph right here shows what that means. So for example, you bought, because I'm on the Apple train, I'm just going to keep going. You bought Apple at 10. I don't know when that was, a long time ago. And obviously those shares appreciated throughout your life. And then say you pass away right here when it's at 40. Normally you would have to pay taxes on that, right? On that growth. But when you pass away, what happens is they adjust this basis right here all the way up into what it was at the date of your death. Or you can use an alternative date whenever you're valuing cost basis, but that's it gets into the weeds a little bit. But if you're interested in talking about which one do you choose, let us know. But basically that gain essentially gets moved up here. So when your heirs inherit the money, they have no tax gains if they were to sell it right away, because it got bumped up to whatever it was at the date of your death. So that's a nice way of minimizing the taxes that have to be paid if you're looking to have some of your money go to your heirs directly. This step up in basis is a really great gift that you can give your heirs if that's what you're looking to do with your funds. And last but not least, I know we went through some tax ideas and all of the different tax strategies we have. They can get very specific to your situation. So we're happy to talk through whatever of the strategies you would like to employ or you're curious about. And if we need to, we can kind of work with your CPA or your accountant, but those are just some thoughts. So let us know what questions you have specifically. Also, I will say that tax forms will probably be coming out in February at some point, whenever they all are ready. So let us know if you have any questions as you get those. But as I would like to close up my little part today, since we're still in January of 2021, there's just a few. I'm really big on New Year's resolutions myself. I always have a whole list of them, and thus far, I'm doing good. Granted, I know it's only January 14th, so I guess check in with me at the next webinar we have or the next time you see me. Keep me accountable. But some financial resolutions that would be really great thoughts for 2021. First off, make a budget if you don't have one. And if you do have one, maybe just revisit it. Make sure the numbers on there, the expenses you have on there, are accurate with what's happening, or maybe 2021 brings a different set of expenses, higher or lower. So just revisit the budget, make sure it's right. If you don't have an emergency fund, make sure that you are building towards one, because you never know what's going to happen, especially in 2021. The other one is start or increase your savings for retirement. I know I talked about this last time, but if you get any bonuses or things like that, use that and throw that into your retirement, because you won't really be missing the extra income from the bonus. You're used to living on whatever your normal salary is. So if you can stash that extra away, it's crazy how much that can grow and compound. And you get tax savings, like I said earlier. Another resolution is to pay off your debt and try not to take on any more. It's awesome how freeing you can feel without having debt. I talked about a lot of strategies you can use to give to charities that you believe in. And last but not least for resolutions is just make sure to get all your affairs in order. You have a will, you have a powers of attorney, things like that. And make sure that everything is simplified in your life. If you need help simplifying things, consolidating accounts, whatnot, let us help you. We just want to help make your life organized, simplified, and set up so that you don't have to worry about it. So these are some good, hopefully inspirational financial resolutions for you. If you have any questions about them or want to talk through them, we're happy to. And finally, I'll just throw this slide on up here. I know we didn't take questions throughout this because your financial situations are very unique to yourself. And so we want to make sure that we commit the time to talking to you individually about what your specifics are. So let us know what questions you have on any subjects that we talked about or anything having to do with your finances, and we're happy to help you. You can give us a call, shoot us an email, and we're happy to talk with you. And this is going to be recorded and put up on our YouTube. So we'll have that up in, probably a day or two. If you want to come back and revisit any of the things that we talked about, you'll be able to do that. But thank you so much for tuning in today. We appreciate your time and you being clients, and we hope that you have a wonderful 2021. Thanks, guys.